Hello my dear students, today I am going to discuss a new topic, new chapter. Its name is balance of payment. So here I have written the balance of payment. First of all, you should know about the meaning of balance of payment. So what is the meaning of balance of payment? So balance of payment is an accounting statement that provides a systematic record of all economic transactions between the residents of a country and the rest of the world in a given period of time. Is it clear? So once again, balance of payment is an accounting statement. What is this? It is an accounting statement that provides a systematic record. Okay, so which kind of record is here? That is the systematic record of all economic transactions, okay, between the residents of a country and the rest of the world in the given period of time. So in a simple way we can say it maintains the records of economic transaction between the residents and the rest of the world, okay, during a particular period of time, and that particular period of time is considered as 1 year. Is it clear? So that is the meaning of balance of payment. Now come to the economic transaction. So first, that is the second point, economic transactions. Okay, so economic transactions. So first of all, you should know what is the transaction. So transaction means the purchase and sale of goods and services from one country to the other countries. That is known as transaction. Okay, so in a common word we can say it refers to those transactions which involve transfer of the title or ownership of goods and services, money and assets. That is known as economic transactions. So first of all, you should always understand that transaction means transfer of title or ownership related to goods, related to services, related to money and assets. Okay, so overall, once again, economic transactions refers to those transactions which involve transfer of the title or ownership of goods and services, money and other assets. Clear? So it is broadly classified basically in 4 parts, but here we will discuss only the 3 main important components. First, that is the visible item. Second, that is the invisible item. And third, that is the unilateral transfer. Is it clear? So there are 3 main components of economic transaction. First is the visible items, second that is the invisible items, and third that is the unilateral transfer. So you should know first of all what are the visible items. So these includes all types of physical goods. Physical goods means that can be touched, that can be measured, okay, that can be seen with the naked eyes. So these are considered as physical goods. So which are exported and imported. Is it clear? So physical goods means those goods which can be measured in terms of unit. It is basically either import or export. So that's why it is known as visible items. Is it clear? Now, second is the invisible item. So invisible items are those items which is related to services such as shipping, banking, insurance, etc. Here you can't measure it in terms of unit. So these cannot be touched, this cannot be felt. Okay, so only the services will be provided here, and that's why it is known as invisible items. So once again, invisible items of trade refers to all types of services such as shipping, banking and insurance. Is it clear? Next, that is the unilateral transfer. So uni means single, okay, or one-sided transfer. So unilateral transfer includes gifts, personal remittances and other kinds of supports which will be given by the one country to another country. Okay, so that is known as unilateral transfer. So in this way, what you find? We find that economic transaction is based on the three most important components. First, visible item, second, invisible item, third, that is the unilateral transfer. Clear? Now, we will discuss about the third point, that is known as a structure. Okay, a structure of BOP, a structure of balance of payment. A structure of balance of payment. Clear? Or a structure of BOP. So balance of payment account uses on the basis of double entry system. Okay, BOP structure is based on double entry system. Okay, so double entry system means what? So one is related to the credit and other is related to debits. Double entry system. One is credit, other is debits. Okay, so the structure of BOP is based on double entry system. One is known as the credit and other is debits. So what is credit and debits? So all inflows or sources of foreign exchange are recorded on the credit side. Okay, so all inflows, so here that is mentioned inflows, and then what will be happen? Outflows. Okay, so all the inflows will be recorded either on the credit side or it is also known as positive side. Okay, and all the outside will be recorded on debit side or negative sides. Okay, now BOP need not be always be equal. Okay, no doubt we say it, that is the BOP, that is the balanced, but really it is not balanced. Sometimes we face the surplus BOP, sometimes we face the deficit BOP, and sometimes it is the balanced. Is it clear? So first, balanced BOP, when receipts of the foreign exchange, always remember in your mind, when receipts of foreign exchange are equal to payment of foreign exchange, then it is known as balanced BOP, balanced BOP. Okay. Second is the surplus. So when the receipts of foreign exchange are more than the payments of foreign exchange, that is known as surplus BOP. And what is the deficit? Just opposite it. When receipts of foreign exchange are less than payment of foreign exchange, that is known as deficit BOP. Is it clear? Now, next point is that is the meaning of balance of trade. BOT or balance of trade. Clear? Now, what is balance of trade? It refers to difference between the amount of export and import of visible items. Once again, balance of trade is the difference between the amount of export and import of visible item, that is known as BOT. Okay, so BOT is equal to export minus import. Export minus import. Okay, and that is also known as net export. Okay, so here what we export? So exports of goods and imports of goods. Okay, so you can say balance of trade is equal to exports of goods minus import of goods. Is it clear? So exports are always entered as credit side or positive side because it is inflows of BOP, while imports are always entered on negative side or debit side. Okay, because it is the part of outflow. Is it clear? So BOT is just a part of BOP. Okay, that is a small part. Why it is a small part? Because BOT includes only the visible item, whereas BOP always includes visible, invisible and unilateral transfer. Is it clear? So according to balanced BOP, that is the balance of trade. Okay, so sometimes our trade will be the surplus and sometimes our trade will be deficit, will face the deficit. Okay, so once again we can say what is the surplus BOT. So if country exports more than what it imports, then the balance of trade is said to be surplus. Is it clear? Or it is also known as favorable for the country. So in a simple words we can say when our export of goods is greater than our import of goods, then it is known as surplus BOT. What is the deficit BOT? It is just opposite of it. If import of goods exceeds the export of goods, then the country is said to have a deficit BOT. Or in a simple word, we can say that import is greater than export. So when our import is greater than export, means unfavorable for the country, or the balance of trade is unfavorable for the country. Is it clear? So on the basis of BOT, one question basically arises, that is what is the difference between BOP and BOT? Is it clear? So first of all, we will take the meaning. So what is the BOT? So BOT refers to the difference between the good amount of goods that is exported and the amount of goods that is imported. Okay, it does not include invisible items. It only includes visible items. Whereas BOP is an accounting statement that provides a systematic records of all economic transactions between the residents of a country and the rest of the world in a given period of time. Is it clear? Second point we will mention, BOT includes only visible items, whereas BOP includes all economic transactions. Third point, it does not record any transaction of capital in nature, whereas it records all transactions of capital in nature. BOT is a narrow concept, whereas BOP is a broader concept. Is it clear? So this is the basic difference between the balance of trade and balance of payment. Clear? Now come to the what are the components of balance of payment. Okay, now component of balance of payment. Components of BOP, balance of payment. So what are the components of balance of payments? So there are mainly two components of balance of payment, that is known as the current account and other is known as capital account. So first, that is the current account and second, that is the capital account. Okay, so one is the current account, other is capital account. Current account and capital account. Is it clear? So first of all, what is current account? It refers to an account which records all transactions relating to export and imports of goods and services and unilateral transfer during a given period of time. Is it clear? So in case of BOP, what was our definition? It mentions all economic transactions. Okay. So one thing I missed, sorry, in the component of BOP, capital transfer also is a part of, capital transfer is a part of capital account. So one thing I missed, that is the component of BOP. Is it clear? So first, unilateral transfer, that is the next. So economic transaction, that is the, okay. So economic transaction includes divided into 4 parts. First, okay. So first of all, when I was explaining that is the economic transactions, I missed it. that was the capital transfer. Okay, because previously I told you that the visible, invisible and unilateral, first of all I will take only 3, not the 4, because I wanted to take it at the time of capital account. Is it clear? So here now I am going to discuss, that is the component of current account. These are the component of current account, and this is the capital account. Capital account. So it has also some part. So here I will discuss. Okay, and that is known as what? It is also known as the component of BOP. Okay, so it is also known as component of BOP or component of balance of payment. So it has two main components. One is the current account and other is capital account. So it has two parts. One is the capital account and other is current account. Current and capital account. Okay, so there are two main components of BOP. One is the current account and other is capital account. Capital account. Clear? So component of current account is visible item, invisible item, and unilateral transfer. Okay, so these are the three main component of current account. Clear? So first of all, we will define the current account. It refers to an account which records all the transactions relating to export, imports of goods and services. And third, that is the unilateral transfer during a given period of time. And that's why it has three main components. One is the visible, next invisible, and last, that is the unilateral transfer. Okay. So visible item is also known as exports of goods, export and imports of goods. It is also known as merchandise. So here we will discuss that a major part of transaction in the foreign trade is in the form of export and import of goods, or you can say in the form of visible item. So payment of import of goods is always written on the negative side or debit side, and the receipts from export is shown on the positive side or credit side. Is it clear? So balance of these visible export and imports is known as balance of trade or trade balance. Okay. Now come to the export and import of services, that is known as invisible items. So I have completed the visible. Now come to the invisible items. So it includes a large variety of non-factor services that is basically sold and purchased by the residents of a country to and from the rest of the world. Clear? So payments are either again received or made to the other countries for the use of these services. So services are generally of three kinds, that may be shipping, banking and insurance. So payment of these services are recorded on the negative sides, and receipts will be always recorded on positive side or debit sides. Okay. Now next come to the unilateral transfer. Okay, so one-sided transfer is known as unilateral transfers. It includes gift, donation, personal remittances and other one-way transaction. So these refers to those receipts and payments which take place without any service in return. Is it clear? So receipts of unilateral transfer from the rest of the world is shown on the credit side, and unilateral transfer to the rest of the world on the debit side. Is it clear? So all the inflows will be recorded on the credit side and all the outflows will be recorded on debit side. Clear? So in this way I have completed the component of current account. Now come to the component of capital account. So first of all you should know what is capital account. Is it clear? So in case of capital account you can say it records all the actual transaction of goods and services which affects the income, output and employment of a country. Okay, the three important things. Once again, the capital accounts. Okay, so capital accounts of BOP are those transactions between the residents of the country and the rest of the world which causes a change in the assets or liabilities of the residents of the country or its government. Clear? Capital accounts, once again, capital accounts of BOP records all those transactions between the residents of a country and the rest of the world which cause a change in the assets or the liabilities of the residents of the country and its governments. Okay. So it has also three main components. One is the borrowing and lending to and from. Second, investment to and from abroad. And third, that is the change in foreign exchange reserves. So first, lending and borrowing to and from. This is the first. Second, investment to and from. Third, change in foreign exchange. Okay, so these are the three main components of capital accounts. Once again, capital accounts are those accounts which are related to assets and the liabilities of the residents of the country. Is it clear? So it has three main components. One is the borrowing and lending from to and from. Second, investment to and from. And third, that is the change in foreign exchange reserves. Okay, foreign exchange reserves. So first come lending and borrowing. So all transactions relating to borrowings from abroad by private sectors, government, etc. That will be borrowing included on the credit side, because the capital is coming from the other countries to our own countries. Okay, so in other words we can say all transactions relating to borrowings from abroad by private sectors, by the government, etc. Okay, that is a part of receipts of such loans and payment, and that's why it will be recorded on positive side. On the other hand, all transaction of lending means to give the money. So all transaction of lending to abroad by private sector and the government, okay, it will be recorded on negative side or debit side because we are making the payment. Okay. Now second is the investment to and from. So investment by the rest of the world in shares of Indian companies, real estates in India, etc. Okay. So here if they are ready to buy our shares, it means the money will flow within our country, in our country, so it will be recorded on the positive side. Whereas if the investment is being done by the Indian industrialist, either in the purchase of shares of foreign companies or the real estates, okay, it means the currency is outflowing towards rest of the world, it means it will be recorded on debit side. Clear? Now there are two kinds of investment. One is known as FDI, foreign direct investment, and the other is known as portfolio investment. Clear? So it refers FDI, it refers to purchase of an asset such that it gives direct control to the purchase over the assets. For example, purchase of land and building. Second is the portfolio investment. It refers to purchase of an assets such that it does not give any direct control, okay, over the assets to the purchase, and that is known as portfolio investment. Clear? Now come to the third, that is the change in foreign exchange reserves. So the foreign exchange reserves are the financial assets of the government. Okay, a change in reserves serves as the financial item of India's BOP. So any withdrawal, okay, if we are taking out, so any withdrawal from the reserves is recorded on positive side, whereas any addition to these reserves is recorded on the negative side. So in this way we can say these are the basic components of capital account. Clear? Now come to the next, and it is the last topic. Okay, so our last topic is what? Our last topic is autonomous and accommodating items. Okay, so there are two kinds of items. One is known as autonomous and other is known as accommodating. So what is the autonomous item? It refers to those international economic transactions which take place due to some economic